Hello, my name is Yemisi Lebushe, and today I want to talk about mortgage life insurance and how valuable it is to you and your family. Mortgage life insurance, in simple English, simply means you have insurance on your life during the amortization period, and you want to make sure that during that amortization period, if life was to happen and you gain admission to heaven, your family does not need to struggle with the mortgage bill. So mortgage life insurance is to protect the surviving partner, the surviving family during that amortization period. So mortgage life insurance means it is an insurance on your life during the amortization period, and the outstanding mortgage benefit, the outstanding mortgage debt is paid to the mortgage lender. I'll repeat again. Mortgage life insurance is insurance on your life during the amortization period. Whatever is the outstanding mortgage debt that you owe the mortgage lender is going to be paid to the mortgage lender because you have a mortgage life insurance, right? And that will happen if there is a situation where the owner of the mortgage gains admission to heaven. So that is what mortgage life insurance offers. Now, the good thing is it is a very good policy. It protects your loved ones and your family living in that house so that they do not struggle to pay off the mortgage, and in a very critical period where they are mourning the loss of someone, they still have to struggle to pay for mortgage. So mortgage life insurance is very good. But there is actually something better. When you have your personal life insurance, you put your family as beneficiary. Your family receives the benefit tax free. They can also use part of that money to pay off the mortgage. So it means the difference between a mortgage life insurance and a personal life insurance is that your personal life insurance, your family or your loved ones receive the benefit, while the mortgage life insurance, the lender receives the benefit. So good morning, my name is Yemisi Lebushe, and on today's topic it is mortgage life insurance versus personal life insurance, and I look forward to your questions in the chat. Okay, so here we go. A quick question. Who would you want to protect? Would you want to protect the mortgage lender, or would you want to protect your loved ones? Which is important to you? Who is important to you? Is the mortgage lender important, or your family is more important, your loved ones? So if you have your mortgage life insurance, you have set up a policy that pays the outstanding mortgage debt to the mortgage lender. But when you have your personal life insurance, the the benefit from your personal life insurance goes to your named beneficiary. Very important, named beneficiaries on your life insurance policy. They receive the personal life insurance benefit, right? Tax free. They can use part of that tax free benefit to pay off the mortgage debt, right? So it is important that you prioritize your loved ones by setting up your personal life insurance. So I get this question always. Let me see, I have an employer life insurance. I don't need I don't need a personal life insurance. That is actually not true. When you have an employer life insurance, it is very good. The employer life insurance, it even comes at a very discount rate. But the challenge with that policy is the day you resign or the day you are laid off, you don't have that policy again, except you convert it from a group plan to an individual plan. And that automatically means you might be paying more. You might be paying more because when you convert a group plan, which is at a discount, to an individual policy, it is possible that you have to increase the premium that you pay monthly for such type of policy. The most important the most important thing you need to know about your employer life insurance is it is not designed to be enough. It was never designed to be enough. So imagine you earn $100,000 per annum per year as salary. Your employer can just give you 100,000 life insurance coverage or 50,000 life insurance coverage, or maximum two times your annual salary, which is $200,000. So the question is $200,000 life insurance policy enough for your family if life actually happens, right? You have bought a property of 800,000, you have three kids, two kids. Even if you are single, you have bought a property, your property is worth 800, 500,000, and your life insurance is just 100,000 or 50,000. So employer life insurance is actually not enough. Okay, So when you have an employer life insurance, you can go ahead to set up a personal life insurance to make sure that you have enough. So if you work with one employer for the next 30 years and the employer gives you $200,000 life insurance policy. In the next 30 years, 40 years, when life actually happens and you're still working in the company and you have $200,000 paid to your family in the next 20 years or 40 years, the value of $200,000 today is not the same value it's going to have in the next 40 years when that benefit is paid out to your loved ones. Yes. So the coverage on from your employer life insurance is actually not enough. And you can still go ahead to set up your personal life insurance policy. Why? Because you want to make sure that in the future, when life actually happens, that we gain admission to heaven, the benefit that is paid to our family is handsome enough to support them financially. It is true when we pass away, right, money cannot bring us back. But that money from our life insurance that is paid out to our beneficiary is paid to them tax free, and that can support them financially during that challenging time. So, yes, you need a personal life insurance, and your personal life insurance, you can use it as your mortgage life insurance. So, mortgage life insurance is defined like this: it's an optional product that pays the balance on your mortgage to the lender upon, God forbid, death happens during the amortization period. Because during the amortization period, which depends on you, it varies from 20, 30, 40 years, depending on what you selected as the mortgage payment period. During that period, any amount of money that you owe is going to be paid to the lender because you choose to set up mortgage life insurance, which is a very, very important product to have. But this product also is very useful. It's just that there's something better. And if you decide to have your personal life insurance, you can use it as your mortgage life insurance. So when your down payment is less than 20% for a house, especially if the property is $500,000 and less, and your down payment is less than 20%, you are going to need to set up mortgage life insurance. In fact, it is actually compulsory, right? So depending on the value of the house, that will determine the standard down payment that you need, right? The three companies that offer mortgage loan insurance or mortgage default insurance are just three in Canada. So the financial institution that you are using to set up the mortgage is going to offer you mortgage loan insurance, like if your down payment is less than 20%. Okay. So the mortgage life insurance or mortgage default insurance is the type of insurance that is compulsory for you to set up if your down payment is less than 5%. Okay, now that is not what we are talking about today. What I'm talking about is mortgage life insurance, right? Mortgage life insurance, that policy, the benefit of that policy goes directly to the mortgage lender. Whereas if you have a personal life insurance, you use the same amount of money, you use that amount to set up your personal life insurance. The beneficiary goes to your spouse or your family or your loved ones. They receive that money tax free, right? The mortgage life insurance benefit decreases as you pay down the mortgage. So initially, you bought a house. Let's say you're in Edmonton, Manitoba, you bought a house of 500,000, or you're in Ontario, you bought a house of $900,000. So this is $900,000. As you pay off the mortgage, the outstanding debt reduces. So it also means the benefit that is going to be paid out from your mortgage life insurance to the lender is going to decrease with time. Is going to decrease with time, and you might actually be paying the same premium, even though the benefit that is going to be paid out is going to reduce every single month, every single year. But you see, when you have uh, a personal life insurance and you select the coverage 1 million, 2 million, $500,000, that is the coverage you will always have, except you change it by yourself. So, year one, like this year, you decide to set up your personal life insurance and you did a 1 million life insurance policy. Even in the next 20 years, if the policy is still valid, right, it is still 1 million that is payable to your family tax free. It doesn't change, except you are the one that go ahead to reduce the life insurance benefit. Now, the value of $1 million today is not going to be the same value that $1 million will have in the next 50 years, but at least that is still handsome enough for a family to receive it supports them financially during a challenging time. Now, the purpose of a mortgage life insurance, which is very, very important. The purpose of a mortgage life insurance is that it pays off your mortgage to the lender if life happens and you gain admission to heaven. So, in other words, a mortgage lender is going to protect themselves financially. If you borrow me $500,000, 1 million, you want to make sure that I pay you back. So that is what happens with a mortgage life insurance. The mortgage lender wants to make sure that if anything happens to you during that amortization period, they get their money back. $1 from $1 does not go to your beneficiaries from your mortgage life insurance. Nothing goes to your family. But when you have your personal life insurance, the benefit goes to your loved ones. Tax free. 1 million goes to them tax free. $500,000 goes to them tax free. There is no other insurance that can do that. Whether you buy toys, whether you buy electronics, that is not going to pay your family 500,000 or 1 million tax free if ever we gain admission to heaven, right? So it's also very important that you know the difference between financial institution and an insurance company. When it comes to insurance in Canada, the best place to get insurance is with an insurance company because they specialize in insurance. Most of the financial institutions that will offer you any type of life insurance, we call them distributors. So if you want value for your money, it is actually good to work with an insurance company through a financial advisor or an insurance agent so that you can get value for your money. Now, the most important thing that you have learned today is the fact that when you have your mortgage life insurance, the benefit goes to the lender. When you have your personal life insurance, the benefit goes to the lender. Your family does not receive any benefit from that mortgage life insurance. The the amount of money that you use to set up your mortgage life insurance, you can use that same amount to set up your personal life insurance. And you can use your personal life insurance as your mortgage life insurance. They do the same thing, the objective is the same. Your personal life insurance, the benefit goes to your family. Your family can use that benefit to pay off the mortgage, right? And they might also have some money extra, right? But from your mortgage life insurance, the benefit must be used to pay off that lender because that is what the contract specifies, right? So the mortgage life insurance, it is based on the mortgage value. If your mortgage is 500,000, then your mortgage life insurance is 500,000. If your mortgage is 1 million, then your mortgage life insurance is a 1 million policy. If your mortgage is 1.5 million, so that is what the mortgage life insurance is, and your net worth will be higher than that. So your personal life insurance can give you the coverage that you need based on your financial analysis, right? Then the mortgage life insurance benefit decreases with time. When you buy a property of $500,000, right, it's not always going to be 500,000. It's going to decrease. What you owe the lender is going to increase every month, every year. So at any point during that amortization period that life happens and we gain admission to heaven, whatever is the outstanding during that period is now paid to the lender. That is what a mortgage life insurance does. The benefit is paid to the lender. Nothing goes to your family. But you can set up a personal life insurance so that the benefit goes to your family and your family can use that tax-free benefit to pay off the mortgage. There are different types of life insurance in Canada, and it's very, very important that you work with a professional that can explain the three different types without bias. Professionally, if an insurance advisor or a financial advisor specifically tells you term insurance is the best, whole life, universal life is terrible, pay attention. They have indirectly told you that they are not licensed to offer universal life or whole life. That is it. That is just the fact. Because professionally, we have term insurance, we have whole life, we have universal life. The choice is yours to make an informed decision. The most important characteristic about whole life and universal life is that it it allows you to have insurance for a very long time until life happens. If it is set up properly and you work with a professional that is experienced, the policy helps you to build cash value based on the amount of money that you put in the policy. What you plant will determine when you harvest. What you plant inside the policy, what you plant inside the policy will determine when you can harvest. It's not the other way around. So people will plant, invest, put money inside their whole life or universal life, and they assume that after 2, 3 years they are able to take out from the policy, they are able to do, and then the policy is still in growth phase. The policy is not even ready to harvest. So it is very, very important that you have this understanding. Whole life and universal life, as good as it is, it has some clauses. What you put into the policy determines when you can harvest, determines when you can leverage on the policy, determines when you can withdraw, determines when you can do collateral loan, right? It is what you plant inside the policy that determines that. It's not your assumption that yes, I'm able to take out money at any time. It doesn't work that way. Term insurance is the most affordable life insurance in Canada, and with like $50, $20, you can set up a term life insurance. But that policy is temporary, it expires. If you were to select term 10, it expires after 10 years and you can decide to renew. If you select term 20, which means life insurance for 20 years, if that policy expires, you can renew. But because you are 10 years older or 20 years older, the cost of renewal is high. But if you choose to set up universal life or whole life, from day one, the cost is high, but you don't pay forever. Unlike term insurance where you have to pay every year, forever until life happens. So if you are someone that you believe in the fact that you have bought a property, you want to buy a mortgage and you know that the amortization period is just 20 years, you set up the mortgage at 35, you pay for the next 20 years at age 55, you don't pay anything anymore. The mortgage still belongs to you. You can leverage on the equity. So that is how a permanent life insurance works. You choose the payment period, you fund the policy, and even when you complete the payment, right, the policy still belongs to you. The tax-free benefit can be paid out to you. Living benefit is available to you. God forbid there's a disability. You can also enjoy compassionate benefit during that period of time. Whether you have a term insurance or a personal or your permanent life insurance, you can enjoy what is called compassionate benefit. And it will vary between 10,000 to 250,000 compassionate benefit from your life insurance policy. So let me know if you have questions in the chat. And it's a pleasure to share this with you. My name once again is Yemisi Lebushe, and the topic for today we talked about mortgage life insurance versus permanent life insurance or term life insurance or your personal life insurance. So mortgage life insurance versus uh, personal life insurance policy. I hope you learned something today. Thank you.